the CIO of Northwestern Mutual Wealth Management. He joins us now to talk about this massive wager on TLT and what was behind it. You had said that it really is kind of signaling a recession at the time we wrote about your being behind this large bet. Now that we are on the precipice of that rate cutting cycle, how do you feel about the future of things?
Yeah, so we were extending our duration because we did believe that the labor market was close to cracking, which is why the Fed is cutting rates today. And I think that's clear based upon the chair's Jackson Hole comments, where he said, we neither seek nor welcome any further deterioration in the labor market. And so to me, when we get to that point in the cycle, at least historically, yes, the Fed does cut rates, but once the labor market tends to start deteriorating, it trends. And that's where we're at today. The question is will these rate cuts keep the unemployment rate from rising? Which at least historically, the answer has been no. And so we view bonds once again as a hedge against downside caused by a recession, which is important because, Eric, you mentioned the prior time where it didn't back in 2022. That's when inflation was taking off. And we view this more as a recession that actually puts inflation to bed once and for all.
And so I think you have company. I did a Twitter poll about 2 hours ago asking people what they thought would have a better return by the end of the year. And you can see there that TLT at 35%, you might be like, well, it's losing to SPY, but that's high. People didn't really have faith in TLT, especially after a lot of people lost money. I think it burned through $6 billion in 2023. So I think this is a trade that is matured. But I guess my question is, do you also look at the short term as well, or do you out of that part of the curve?
Yeah, so I don't think this is a forever holding for us. So it was more of a near-term recession call. And as you mentioned before, it worked out. It's worked out well. And certainly it proved itself during that brief time period, I think when July, where we had the market falter because of the carry trade unwind, recession fears grew. It worked really well as a hedge against equities. This won't be something that we hold forever. Look, I don't think we're done with inflation. I mentioned once and for all. I mean that more in the near term. I think inflation is likely to be higher in the future, and we'll see how far the Fed goes. I mean, my fear is that the Fed does go too far and that inflation embers are not burned out. And so potentially in the future, given the fact that we have lots of company right now, you may see us change that positioning. But for right now, we're comfortable owning it because we do still think the trends are at least headed towards a recession based upon that labor market. And we don't believe the Fed will be able to stop that just given a few cuts in the next few months.
Brent, I think it's been really fascinating to see the way that investors have been using fixed income ETFs to play the market here, both either to reflect a macro view or to be nimble in the way you move in and out of these markets. What else are you buying in that universe? Is there anything that you would be willing to place large bets on or are on the precipice of placing large bets on in the ETF world, particularly as it relates to bonds?
Yeah, no, these were certainly, it was a large bet, but it was done across our retail client base. And so it was spread across hundreds of thousands of accounts that represent the $325 billion that we manage on behalf of our clients. And so it turns out to be a rather large trade, but it was a smaller position in each one of those accounts that essentially took our duration from below market to above market and made our portfolios look like a 10-year treasury, for example, more so, which we thought had more upside in the near term, given the macro outlook that we were expressing at the time. And so from a bond perspective, we do have exposure to other ETFs. We certainly have exposure to fixed income through mutual funds and certainly in our bigger clients, individual bonds per se. But that's where our positioning is right now. We're comfortable from the bond side of the house with the duration that we have and the quality profile that we have, which I heard the prior segment. I think investors should be focused on higher quality duration in the fixed income arena, just given the risks that are out there right now of a recession.